There is a rule that HMRC operates by, and the vast majority of people with a side income in the UK have absolutely no idea it exists. It is not hidden. It is not secret. It is right there on Gov. UK. But because nobody talks about it in plain language, millions of people with side hustles, online selling income, freelance work, and gig economy earnings are either overpaying tax, underpaying tax, or leaving themselves wide open to penalties without even realizing it. Today we are going to go through the HMRC rules that 99% of UK side hustlers do not know. And by the end of this video you will know exactly where you stand, what you owe, what you do not owe, and what you need to do right now in 2026. This is general information and not personal tax advice. Your exact situation can change the outcome, so always check Gov. UK or speak to a qualified UK accountant for your specific circumstances. Today we will cover the rules most people miss, the HMRC Connect system, the hobby versus trade line, the tax year trap, the gross income rule, the digital platform reporting, making tax digital, and the rules around what happens when you have multiple income sources at the same time. The first rule most people do not know is this. HMRC does not wait for you to tell them about your income. They already have a system that collects it. It is called HMRC Connect. It is a powerful data matching and risk analysis platform that pulls information from hundreds of sources: banks, land registry, social media, company's house, benefit records, and now, since January 2024, directly from digital platforms like eBay, Vinted, Etsy, Airbnb, Uber, Deliveroo, and more. HMRC Connect compares what you declare on your tax return or do not declare against the data it holds from these sources. When there is a gap, that is when letters get sent and investigations get opened. And the critical update for 2026 is this. The first major reporting deadline for digital platforms was 31 January 2026. That means HMRC now has a data file with the names, addresses, national insurance numbers, and total earnings of sellers on all major platforms for the 2025 calendar year. The rule you need to know is simple. Assume HMRC can see every penny you earn online, because in 2026, they very nearly can. The second rule most side hustlers do not know, and it is one of the most important, is where HMRC draws the line between a hobby and a trade. This matters enormously, because if HMRC decides your activity is a trade, your income is taxable. If they consider it a hobby with no profit motive, different rules may apply. But, and this is the part people miss, HMRC does not care what you call it. What matters is what you actually do. HMRC looks at specific factors to decide whether something is a trade. These include how regularly you carry out the activity, whether you are making a profit or intending to, whether you buy things specifically to sell them at a higher price, whether you advertise or promote what you do, and whether the activity is organized in a business-like way. So if you are buying items cheaply and selling them for more, even occasionally, HMRC is very likely to treat that as trading, not a hobby. If you make things and sell them regularly online, that is trading. If you provide a service to people in exchange for money, that is trading. The rule is this. Do not assume that because you think of something as a casual hobby, HMRC sees it the same way. If there is a profit motive and regularity, it is almost certainly taxable trading income in HMRC's view. Here is a rule that catches people every single year. The UK tax year does not run from January to December. The UK tax year runs from 6 April to 5 April the following year. So the 2025 to 2026 tax year runs from 6 April 2025 to 5 April 2026. Why does this matter for side hustlers? Because people track their income on a calendar year basis. They think January to December and assume that is what HMRC cares about. But HMRC measures everything April to April. This means, if you started a side hustle in, say, February 2025, the income from February to 5 April 2025 falls into the 2024 to 2025 tax year. The income from 6 April 2025 onwards falls into the 2025 to 2026 tax year. You need to track both periods separately. And the registration deadline follows the tax year too. If your gross trading income exceeded £1,000 in a tax year, you must register for self-assessment by 5 October following the end of that tax year. Not by 5 October of the calendar year. By 5 October following the end of the tax year that ran to 5 April. Get this wrong and you miss your registration deadline. Miss your registration deadline and you get a penalty even if you do not owe any tax at all. We touched on this in the trading allowance video, but it is worth going deeper here because it is the single most misunderstood rule in UK side hustle tax. Every threshold in HMRC's side hustle rules the £1,000 trading allowance. The registration trigger, the reporting threshold is based on your gross income, not your profit. Not your take-home, your gross income. Gross income means the total value of everything you sell or earn before any deductions whatsoever. Before platform fees, before delivery costs, before expenses, before anything. So many people look at their bank account, see the amount that arrived after all the platform fees and deductions, and use that number to decide whether they are over or under the threshold. That is wrong. And it can lead people to believe they are under the £1,000 limit when they are actually over it. Track your gross income carefully. Add up the total value of every sale at the sale price before any fees are taken off. That is the number HMRC cares about. That is the number you measure against the thresholds. 7, 8, 15. Rule 5. Your side income is taxed on top of everything else. This is a rule that surprises a lot of people who have a job and a side hustle at the same time. When you have employment income and side hustle income, HMRC does not tax them separately. Your side income is added on top of your employment income, and the combined total is what determines your tax rate. This means if you are already a basic rate taxpayer through your job and your job income takes you above the personal allowance of £12,570, then every pound of side hustle profit you make above the trading allowance is immediately taxable at 20% or higher depending on your total income. And if your job income already takes you into the higher rate band above £50,270, then your side hustle profit could be taxed at 40%. People often think their side income is somehow separate or treated more leniently. It is not. HMRC combines all your income sources. Your marginal rate applies to your side hustle profit just as it applies to any other income above the personal allowance. From 6 April 2026, a major new system called Making Tax Digital for income tax went live, and the majority of side hustlers who are growing their income have no idea what it means for them. Here is what it means in plain terms. If your total income from self-employment and property combined exceeds £50,000 per year, you are now required to keep digital records and submit quarterly updates to HMRC using compatible software instead of one annual tax return. That means 4 submissions per year instead of 1, plus a final annual declaration. 5 total interactions with HMRC per year instead of 1. From April 2027, the threshold drops to £30,000. And from April 2028, the plan is to extend it to those earning over £20,000. So, if your side hustle is growing and you are approaching these income levels, this is not something you can deal with later. You need to start keeping clean digital records now, understand which software is compatible, and be ready to submit quarterly when your income crosses the relevant threshold. Here is another rule that catches people completely off guard, especially those who have more than one side hustle or income stream running at the same time. The trading allowance is one single £1,000 allowance. It does not reset for each side hustle. It does not apply separately to each platform. It applies to your total combined gross trading income across every source. But the rule goes beyond just the trading allowance. When you have multiple income sources, employment, self-employment, property income, savings interest, all of these need to be considered together when working out your overall tax position. And for registration purposes, HMRC looks at your total picture. If you have a job, freelance work, and sell on eBay, all of these income streams can affect whether you need to file a self-assessment return and what tax you owe when you do. The important thing is to never look at your side hustle income in isolation. Always look at it in the context of your full income picture for the tax year. That is what HMRC does. And that is what you need to do too. This is the rule that surprises people more than almost any other, and in 2026, it is more relevant than ever. HMRC uses artificial intelligence to scan publicly available information, including social media. If your lifestyle or visible income on platforms like Instagram, TikTok, or Facebook does not match what you declare to HMRC, that discrepancy can trigger a compliance check. This is not a future possibility. It is happening now. HMRC employs thousands of people and significant technology resources to identify gaps between declared income and visible lifestyle indicators. So if you are posting about your side hustle on social media, showing products you sell, advertising your services, or displaying a lifestyle that suggests income and that income is not on your tax return, you are creating a visible trail that HMRC can and does follow. The rule here is not to avoid social media or stop promoting your business. The rule is to make sure what you declare to HMRC matches your actual income. If it does, you have absolutely nothing to worry about. This is one of the most practical rules and one of the most commonly missed. If your gross trading income exceeds £1,000 in a tax year, you must register for self-assessment by 5 October following the end of that tax year. This deadline is firm. And missing, it carries an automatic penalty, even if you do not actually owe any tax. Let that sink in for a moment. You can earn a modest amount, have no tax liability after allowances, and still be fined simply for not registering on time. The process itself is straightforward. You register online through Gov. UK. You need your national insurance number and some basic personal details. The whole process takes around 10 to 15 minutes if your information is ready. Once registered, HMRC will send you a unique taxpayer reference, your UTR number. You need this to file your self-assessment return. And the deadline for filing and paying any tax owed is 31 January, following the end of the tax year. So if you cross the £1,000 gross income mark in the 2025 to 2026 tax year, which ends 5 April 2026, you need to register by 5 October 2026 and file and pay by 31 January 2027. The final rule, and arguably the most important one if you have made mistakes in the past, is the voluntary disclosure rule. If you have undeclared side income from previous tax years, whether from online selling, freelancing, renting out property, gig work, or anything else, you have the option to come forward voluntarily and disclose it to HMRC before they find it themselves. This is called an unprompted voluntary disclosure, and HMRC treats it significantly more favorably than a case they discover through their own data systems. When you come forward voluntarily, penalties are reduced substantially. HMRC understands that people make genuine mistakes, especially around rules that are not widely publicized. The process involves calculating the correct tax owed, paying any interest that has accumulated, and paying a reduced penalty rather than the full amount. The key principle is this: the sooner you act, the better your outcome. With HMRC now receiving platform data directly, the window for genuinely unprompted disclosure is getting smaller every year. If you know you have undeclared income, 2026 is the year to deal with it proactively. Let us bring it all together. Here are the 10 HMRC rules that 99% of UK side hustlers do not know. HMRC already has your data through the Connect system and digital platform reporting. The line between hobby and trade is drawn by HMRC, not by you. The UK tax year runs April to April, not January to December. Every threshold is based on gross income, not profit or net receipts. Your side income is taxed on top of all your other income. Making Tax Digital is live from April 2026 for higher earners. The trading allowance is one combined allowance, not per platform. HMRC uses AI and social media to identify undeclared income. The registration deadline is 5 October, not 31 January. And voluntary disclosure is always better than being found out. Know these rules, apply them correctly, and your side hustle stays profitable and stress-free. If this video helped you, please like and subscribe to HustleWise UK for clear, honest UK tax guides every single week.